Good everyone, welcome back to our next edition of Econ Talks. Gareth, we've had the latest economic activity data come out from Stats NZ for the second quarter of the year, a contraction, 0.2% fall, following a revised 0.1% increase. So not technically in recession yet, but let's be real, if you look at the numbers, there's still a pretty difficult stance out there in the economy. If we look at the production side of GDP, you saw falls, particularly in forestry, big plunge in forestry activity, about a 10% drop. Contractions as well across the likes of construction, retail and wholesale trade, accommodation and food services. So not a particularly upbeat story there. Oddly enough, or I guess sort of one of the challenges with this release is that there wasn't sort of a clear trend in that not every industry went down. And so you saw, gains in the likes of financial services, in health and information technology. So a few sort of continued areas of activity out there in the economy. Very mixed bag, sort of very patchy to try and get a good read or steer on the economy. Also sort of an odd one, we saw quite a big boost in transport manufacturing activity and feeling that actually, manufacturing, all the reports seemed to be that it wasn't doing well, but all of a sudden you had a burst coming through there. So again, some sort of ups and downs. On the expenditure side, we saw that consumer spending, household spending, private consumption, all the various elements of that did increase. Not much, sort of a continued 0.4% quarterly rise. Quite different, though, from the sort of picture we had at the first quarter of this year, when what we were seeing and being told was that actually there was a big boost in consumer spending, big drop-off in tourism activity. Stats has now gone back and tried to figure out what's happening with their numbers and gone, well, it feels a bit odd that we had a 13% contraction in tourism exports and a 1.5% boost in consumer spending. Maybe that's not quite exactly what happened. And so, again, those revisions now sort of giving us a clearer pathway that tourists are spending, but that's plateauing, as we have sort of thought, and that consumers, again, still spending, but are being a lot more restrained with their spending growth than they would normally be. Spending per capita remains pretty poor. I mean, across all of those results, I guess the question has got to be, where to next? Are we going to see an immediate rebound now that interest rate cuts have started to come through, or is there still some weakness to come?
There's probably still weakness to come. I mean, we know that those interest rate cuts do take time to flow through and have an impact on the real economy. We know that households have been fixing their mortgages right down the shorter end of the curve, so that effect may come through a little more quickly than the sort of rate rises and how slow they were to impact on the economy on the way up. But probably more importantly for me at the moment, obviously over the last 6 weeks or so, we've had the energy crisis and electricity shortages, which those pressures have dissipated a little bit, I think, over the last couple of weeks. But nevertheless, we've seen the sort of flow-on impacts in terms of reduced manufacturing activity and factory closures. So Tiwai Point, of course, shutting down one of their pop lines, and that's going to be shut for several months. And then we've had some other factory closures in the Ruapehu district and one announced also up in Auckland this week. And so all of that sort of weakness in their manufacturing, specific areas of manufacturing, is going to impact. You've got obviously job losses associated with some of those factory closures as well, and other job losses which are still flowing through the economy. So look, I think the September quarter that we're in at the moment, that will be probably a negative quarter given that electricity effects coming through. And beyond that, probably over the next 6 to 9 months, still patchy growth, much like we've had for the last 18 months or so, where it's a little bit positive, it's a little bit negative, but the economy essentially at best has been going sideways. So, still not an immediate turning point, but there is just a bit of sense, I think, coming through in the numbers that we are on the cusp of things starting to turn a bit more positively. You've had a big lift in business confidence recently. You had some reasonably strong investment numbers in those latest GDP, which may be a little premature for businesses, looking to get in ahead of the next upturn, but who knows? So there's just export prices as well. That's the other one which have been trending up in some areas. Again, not across the board, but beef prices and dairy prices have also been improving. So there's enough there when you take that all together to go, okay, 12 months' time, the economy will be on a better footing, but I don't think we're quite at that space yet.
Totally. And the thing here, right, is you've got some ups and you've got some downs for the next couple of quarters in terms of, manufacturing output down, but, meat exports likely up. What I think was interesting as well, you talk about the energy challenges that we've had, and I think it's one of those areas where if it was only the energy challenge in of itself, you might be able to sort of struggle through. But for a lot of those businesses, again, when you're seeing a 10% odd drop in forestry and logging GDP, you're seeing, a 14 odd % drop in forestry product exports. It sort of highlights that you don't have great global demand, you don't have great global pricing, and you've got much, much higher on the cost side. If your revenue is down and your costs are up, that is a bad situation all year round. And so that's, I think, probably both of those together rather than just any one of them that's causing some of these closures to come through. You're right about the investment. I mean, I was fascinated looking through the figures. We saw a contraction in residential and non-residential building, totally expected. We've been seeing that in the work put in place numbers. But we had a pretty big boost, or a sizable enough boost, in other construction or infrastructure investment, we'd normally call it. A boost as well in the likes of, transport equipment investment and in plant machinery and equipment across the board. And actually, investment gains were their strongest in 1.5 years. Now, it's coming off a lower base because there's been those contractions, but it did sort of just highlight that maybe people are, like you say, it might be a bit premature to massively try and do a lot of investment, but maybe just a little bit of a shift in that business tone there, which, like you say, sets the scene for something better. At the same time, we've had the US Federal Reserve that's cut the federal funds rate by 0.5 percentage point, sort of the bigger move that they could have gone with. That has prompted some pretty big reactions on the stock market. Funnily enough, everyone thinks that interest rates coming down is going to jazz up the economy like no tomorrow. And given the US economy, they might well be right. But it was interesting also, if you listen to the press conference afterwards, the governor of the Federal Reserve did highlight that, look, there's still a little bit of caution, I guess, out there in terms of how quick the pace for further interest rate cuts might be, i.e. this might not be sort of a 50 basis point cut each and every time. And also within the last 24 hours, we've had the Bank of England who have decided to keep their rates on hold for the moment. Again, just inflationary pressures, labour market, a whole lot of other factors that people are keeping watch. If you've had the Fed pull the trigger finally, Gareth, you've got GDP activity, though, that actually at 0.2% down, it was a contraction, but it was actually a lot better in a sense than what the Reserve Bank thought. They were picking a 0.5% down. The rest of the market was picking on average 0.4% down. The Infometrics pick was bang on at 0.2, well done to the forecasting team. But I mean, if you've got what is a relatively better starting point for the Reserve Bank, but other central banks around the world starting to cut, where does that leave us?
I mean, for me, it comes back to where the inflationary pressures have been generated from. And when we look at inflation over the last 2 years, the moderation has been almost solely driven, not entirely, but most of it coming through from tradable prices or international price pressures. So the Federal Reserve cutting by 50 basis points because they think they've got inflation under control. There's not really a lot of news in that in terms of our own inflation outlook. The key for me still is, what does the Reserve Bank see in terms of domestic or non-tradable inflation going forward? And like you say, the growth numbers that we've had here don't especially change the picture. They're probably a little bit better than the bank was picking. And so therefore, a drastic 50-point cut here, probably not on the cards at the October meeting, certainly. November, I'll still hold my judgment back on the basis that it's 3 months till the next meeting after that. But for now, I think 25 points is probably the way to go in terms of the Reserve Bank's action from here, and just still taking a cautious approach. Keep an eye on the exchange rate, though, because of course, if the Fed is cutting rapidly and our interest rates stay higher, then that potentially does become attractive for foreign investors. And if that exchange rate does start to shift north pretty quickly, then I would expect more drastic or sharper action from the Reserve Bank to try and soften the effects and limit the negative effects of a higher exchange rate on exporters, because that is one of the few areas where we do see growth starting to come back at the moment.
And that's going to be the toss-up for the bank, right, is that they're going to be looking primarily at the inflation outlook and pressures there, but they've got a keen eye on the exchange rate at the same time. You can't fight that one massively. We've seen and failed before as a country to try and fight the exchange rate battle. But I think your point there is much more around that sort of relative interest rate position. And that's where I think, there has already been some currency moves in the last couple of months. New Zealand moved, the Fed hadn't at that point, which had sort of changed the differential. Maybe now things coming back a bit more into alignment. So again, a lot of moving parts in the economy at the moment. I think, like you say as well, no real case in my mind for a 50 basis point cut in October. I just don't think there's any data that's come out that has said there needs to be a more rapid shift. But you're right, not only about the fact that there's a 3-month break after the November meeting, but the bank also has a monetary policy statement at that point, so it can give full forecasts, a much greater level of detail than it can in October to explain what it thinks it's doing. And I think everyone in the market would be better off to wait for that rather than to sort of wait for maybe a half-coded message in a monetary policy review that the bank then thinks, why didn't everyone in the market listen to all of our absolute detailed nuance that we totally put out? So we'll continue to assess that into the future, how the interest rate outlook moves, how economic activity trends, and a whole lot else on one of our future editions of Econ Talks.